Hey guys, hope you're doing well out there. It's time to take a look at one of the most anticipated earnings, probably from the whole year, I would say, and that is Tesla's Q1 report, which came out after the bell. And look, this was one of Tesla's hardest quarters, in my opinion, and that's to no surprise. I think we all expected the numbers to be pretty abysmal, but they did come in actually worse than expected. But you also had Elon Musk hop on the conference call and really pump this stock and pump Tesla, talk about its future, talk about the secular trends he sees down the road. And honestly, he did a pretty good job. His shares are up nearly 11% in the after hours. But Elon really focusing on the future of Tesla instead of the past 3 months. Here on the stock study, we unfortunately do have to analyze Tesla's past quarter and really see how disappointing these results really were. So we'll jump into all the financial statements and the summary, and then we'll also take a look at the stock chart and see where the stock is really headed and if this rally has legs to run. As always, if you're new to the channel and find this type of content valuable, be sure to hit that like and subscribe button below. It would be much appreciated. Shares of Tesla rocketing higher nearly 10.5% in the after hours, basically making up your 1 year losses, which are down nearly 11%. Year to date, though, you still have a lot of work to do as shares are down close to 40%. Now, revenues came in at $21.3 billion for this most recent quarter. That was down roughly 8.5% year over year. Consider the fact that inflation is also at 2-3%. You adjust this for inflation. Yeah, revenues of Tesla down nearly 10% as shares are higher by close to 10%. Also missing expectations on Wall Street by close to $1 billion. So pretty low expectations on Wall Street, which were being dragged down over the past, call it month, 2 months. And even that, Tesla came in and actually missed those. Non-GAAP EPS coming in at 45 cents. That did, again, miss estimates, which were already lowered by 5 cents. Now, there were a lot of reasons why this was one of the hardest quarters for Tesla. And the first reason they said is just the fact that they've lowered average selling prices significantly over the past 3 months in order to meet that lower EV demand. On top of that, they just had lower vehicle deliveries. We got the vehicle delivery numbers a couple of weeks ago. But a few of those reasons actually for the lower deliveries were out of Tesla's hands, and those being the arson attack on their Giga Berlin factory, along with the conflict in the Red Sea. Those are the two things that Tesla really highlighted on their investor presentation. Along with that, you did have the Model 3 update or the Model 3 refresh, which took down that Model 3 production line for a little bit. On top of that, you still have Cybertruck ramping and then continued investment into their AI infrastructures. And we'll see that in their CapEx, as that is close to $2.7 billion, as Tesla really betting heavy on their AI infrastructure, really betting heavy on full self-driving, which they recognized higher revenue due to the release of a new auto park feature in North America. But with that higher CapEx comes lower free cash flows. And actually, Seeking Alpha has this wrong. They produced negative $2.53 billion in free cash flow as compared to positive $440 million last year. So that free cash flow turnaround, pretty stark, pretty substantial. And so the numbers really are ugly, like we said, over the past 3 months over at Tesla. But hey, a lot of people say Elon Musk is a visionary, and what a visionary does is they look ahead into the future. They don't really reflect on the past, or at least dwell on the past for too long. And so Elon says that the robo-taxi fleet could make non-autonomous cars obsolete, and he actually said it could do it in a pretty short amount of time. So on the conference call, Elon actually had a lot of things to say, and the first one being that, look, EV adoption is still under pressure globally, even outside of China, as there's really just a slowdown in the demand. But he still thinks that EVs will continue to dominate the automobile industry over the long term. He also sees that the new model, or the more affordable or next generation vehicle, will be launched in the early part of 2025 or even later in 2024. Now, we know Elon is pretty aggressive on his timelines, and usually they're not met. And the fact that he even said late 2024 is, again, I'd say pretty aggressive. I wouldn't expect this early production models to come in at, say, at least mid 2025. And that will be using parts of the autonomous technology. Now, the really good thing that he did mention is that the new models will be built on existing production lines. I think that is actually huge and is a massive deal for Tesla. The fact that they don't have to go in, refresh production lines, or really build new production lines for a new, more affordable model, that is actually a huge, huge step. And it just makes me think that the newer model likely won't be too far off from your Model 3. Might be even a two-door Model 3, essentially, just the fact that you can put it off from the same production lines. Now, Musk also talked the upside of full self-driving, and he said that essentially if you haven't tried out full self-driving 12.3, you really have no idea what Tesla is doing. the fact that he's so bullish and so confident on FSD 12.3 really is startling and makes me think that there might be something there. He also said that the neural networks with cameras is the right solution for FSD. We know Tesla moved away from those LiDAR sensors towards cameras, and again, Elon sticking with that, saying that that's the right approach. He is saying that the AI computing power is making rapid progress and that Tesla is in talks with at least one major automaker about licensing FSD. And he said that FSD really should be an essential part in all vehicles at some point down the road. And the fact that these other automakers, if they really don't choose to put FSD in their vehicles, they'll simply get left behind and their vehicles will be like riding a horse. And that's not my quote, that is Elon's. And so Tesla really getting ahead of the curve, knowing that their FSD is the best out there. They're willing to license that out to other automakers. In my opinion, it's actually a really good business. The fact that they can probably make software-like margins just licensing out FSD. Along with that, they'll probably get a lot more data and a lot more miles in order to improve their FSD if their FSD are also part of other automakers. So in my opinion, a fairly good strategy. Now, Elon was also asked about Optimus, which is their humanoid robot, and he expects the company will be able to sell the humanoid robots by the end of the year. Another aggressive timeline, in my opinion, for Tesla, but the engineers over there are some of the best in the world, so if there's someone that can pull it off, probably over at Tesla. He still also thinks that Optimus could be the largest business over at Tesla. He did say it could be a bigger business combined than all the other businesses. And so that, again, still really bullish for Optimus. Really the use cases I see for this is within Tesla's manufacturing facilities. Really think Amazon warehouses, but likely Amazon will have their own robot technologies. And so like a Walmart, like a Target even, could benefit from robotic solutions like Optimus. Now, I think we'll still have to wait and see if that's possible by the end of the year. Now, he did say that it's helpful that other automakers are forging a way with regulatory approvals on autonomous driving. He did say that there's not too many barriers, surprisingly, to regulatory approvals for FSD, for autonomy. But I think he is coming from the perspective of mainly San Francisco, really California and the US. But outside of that, there's going to be a ton, especially in Europe, especially in Canada, there's going to be a ton of regulatory scrutiny on FSD, on autonomy. Really the way our roads and our infrastructure is built, I think, would also have to change in order for autonomy to be fully capable on its own. He also leaned on the data showing that the autonomous driving is actually safer than human driving. Now, I think that sort of data would help in terms of regulatory approval, but still, I'd say is a long, long way away before you convince anyone really in power that autonomy is safer than human driving. He also envisions robo-taxis as a combination of Uber and Airbnb. So think that Tesla has some of their own cars under their own fleet, but also other customers that own Teslas can likely add or remove their vehicles to Tesla's robo-taxi fleet really anytime they want, and could essentially rent those out similar to how you do with a room on Airbnb. And like I said, Elon's quote, in the future, gasoline cars that are not autonomous will be like riding a horse and using a flip phone. And that is going to be soon very obvious. In my opinion, I think we're still a ways away from that, but seeing how fast FSD 12.3 is learning is certainly impressive. And really that's what we see on their core technology chart. Tesla is accumulating those FSD version 12 miles at a pretty staggering rate, and that's contributing to their end-to-end neural networks, to their AI infrastructure, and really improving supervised FSD. And so as long as that continues to chug along, I think FSD honestly could be really good in majority of the driving situations. You will still have one-off situations where certainly the human probably can drive better than the car itself. The other thing they did to really boost up these FSD version 12 miles was to include a 30-day free trial to eligible car owners in the US and Canada. Along with that, they actually reduced the price of their full self-driving or autopilot down to $99 a month, down previously from $200 a month. And then the upfront, if you want to just buy it upfront, that cost is now $8,000 instead of $12,000. So I think reducing these costs, allowing more users to get a hands-on approach to using FSD, trusting FSD, and seeing how really good it is. Along with that, you have Tesla gaining all those FSD version 12 miles from which they can just improve their FSD algorithms. Now, as we know, this most recent quarter was really challenging over at Tesla. Their total production numbers came in at 433,000. That was down 2% year over year. It's the deliveries that really stood out and really caused this big sell-off earlier on in the month, as your deliveries came in at just 386,000 vehicles. That is down 9% year over year. Some estimates, in fact, the lower estimates on Wall Street were closer to like 400,000, some even 410, 412,000 deliveries. And Tesla coming in at close to 386,000 really spooked investors and showed that the demand, despite lower average selling prices, despite Tesla really reducing prices across the board, demand just simply is not there, both in China and outside of it. On the bright spot, you do have more storage deployed, as that's up 4% year over year. You do have more supercharger stations and supercharger connectors, along with more Tesla locations. So you do still have the overall secular trend in more energy and storage. It's just the EV production and EV deliveries in this most recent quarter fell off a cliff. And that's really visible in their numbers, as we see $21.3 billion of total revenues, down 9% year over year. Your automotive revenues were down 13%, but your energy generation up 7%. So like we just saw, energy and storage doing good, but the automotive revenues, which still is the majority of this business, the bread and butter of Tesla, still in large part the automotive business, down 13% year over year. And so your gross profits went down 18% year over year, coming in at just $3.7 billion. That is gross margins of right around 17.4%. Last year, we were closer to 19.3% on our gross margins. In terms of operating expenses, those continue to bump up, as that's up nearly 37% year over year. Pretty substantial bump up on the operating expenses, leading to operating margins of just 5.5%. Last year, we were close to 11.4% on those operating margins. So those operating margins, income from operations, really getting squeezed. Now, Tesla recently did announce some layoffs, and so I think they saw these operating margins get absolutely shriveled up, and looking to cut costs, looking to make the business more efficient. Those operating margins and gains will really be seen in the subsequent few quarters, I would say. Same thing on your EPS, as that is down nearly 50%, coming in at just 45 cents a share on a non-GAAP basis. Last year, you were closer to 85 cents a share. And really where this tough quarter is most visible is on their cash flows. As we see, they printed just $240 million of operating cash flows. That is down 90% year over year. That is a staggering number. That is like you're going out of business sort of number, with your operating cash flows down 90%. And then your your capital expenditures were up 34%, coming in at $2.7 billion. This company did say they're still ramping Cybertruck, and they're still continuing to invest heavily in their AI infrastructure. And so their CapEx really isn't slowing down. And what that will do is absolutely obliterate your free cash flows, as those came in at negative $2.5 billion. Like we said earlier, last year they were sitting on $440 million of positive free cash flow. And so that is a huge swing in your free cash flows. This company is still sitting on close to $26.8 billion of cash and cash equivalents. So nothing to really be overly concerned about. This company still has a ton of cash and cash equivalents, still in a really good liquid position, that a quarter like this doesn't really damage them all too much. But certainly if a quarter like this tends to continue, if let's say Q2 and Q3 also have negative free cash flows of right around $2 billion, yeah, this $26 billion of cash and cash equivalents will get dwindled down pretty fast. And so while for now it looks okay, the fact that if this trend continues and really continues over, I'd say 2 or 3 more quarters, that would be pretty concerning. Now, from their balance sheet, we can also see the inventory levels over at Tesla really continuing to bump up. As you see, last year, they were closer to $14.3 billion in inventory. Now they're sitting at nearly $16 billion. So while they're continuing to have less and less demand, they're having to hold on to more and more inventory. Certainly not a good sign. Again, if this is a trend we continue to see over, I'd say 2 or 3 more quarters, that is where I would get concerned with Tesla. Now, with Tesla having a pretty tough Q1, keep in mind the expectations coming into these earnings were really on the floor. No one was really expecting anything great from Tesla, especially in the numbers. Maybe they were expecting some things from the conference call, maybe saying that the margins were looking to have bottomed out and maybe they'll continue to tick up in the subsequent quarters. But instead, we got a ton of hype from Elon in terms of full self-driving, and that really helped the stock, as that is up nearly 12% in the after hours. Now, this one is looking to enter back into this downtrending channel. It did break through it pretty aggressively back in the second week of April and recently made lows closer to $140 a share. Certainly, if Tesla can poke its head back up into this channel of lower highs and lower lows, certainly has the ability to continue to trade in this range somewhere between 150s all the way up to probably call it 200s And there is a fair amount of support and resistance you can find between these levels. Probably the first level of resistance Tesla would face, I'd say closer to $170 a share. Really, that's where we've gone rejected a couple times in the past. And so that's really the first level of resistance I would be looking at in terms of Tesla. From there, I can see it getting rejected, coming back closer to this 150s, somewhere to 160s. Really, if you've picked up shares of Tesla anytime over the past, call it 2, 3, 4 years, you're probably sitting underwater unless you timed it right at the lows. And so somewhere in this range of 150s up to 170s, actually not a terrible spot to dollar cost average to continue to accumulate shares of Tesla and lower your cost basis. At these levels, I certainly wouldn't unload a full position because you can still break through this 150 support and again then break through this 140 support and head lower if really we see no signs of demand picking back up. But in my opinion, I think the worst and the hardest quarter for Tesla is honestly behind them at this point, and continuing on in the year, I think the comps will get easier and easier, and really demand, I'd say in the back half of the year, would be looking to be picked up. And so as long as they can make good on all of their promises, and full self-driving is really what Elon says it is, I think this company, from a technical perspective and from a stock perspective, probably wildly undervalued rather than being wildly overvalued. In my opinion, right now, I would just look to pick up shares of Tesla incrementally somewhere in this range up to $170 a share. If you have a long-term buy and hold time horizon, I think shares of Tesla at these levels certainly do make a lot of sense. And then on top of that, if all the things that Elon has said, and really Tesla has said, that a more affordable car will be produced sometime later this year or early 2025, on top of that, you have full self-driving really becoming what Tesla is predicting, that cars in the future will require autonomy. If they can look to license out FSD, if Optimus really does become more valuable than everything else combined. And then lastly, if the future of robotaxi is really what Tesla says it is, I think this company, from a value perspective, is actually probably wildly undervalued. But those are a lot of ifs and buts to keep in mind, and we're probably likely a long ways away from a lot of those things coming to fruition. And so until then, until Tesla can really prove those out in meaningful ways in their numbers, I think all of those things are just to be taken with a grain of salt. I think this company still, much more than anything, does move on their automotive revenues, and those are still the things you should be paying most attention to anytime Tesla reports. That was my take on shares of Tesla. Let me know your thoughts on this one in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.